I'm Professor Indra Abeysekera. Let's look at hedge accounting forward contracts. Here we will look at with fair value measurement. In a hedging situation, there is a underlying item and there's an existing risk in relation to that underlying item. A fluctuation in price, for example. We take a underlying instrument or a hedge instrument or a derivative to offset that risk. So it could be about price in relation to value, or it could be about cash flow. But here we're going to focus on the fair value, for example, the price. So the underlying item could be a financial or non-financial, and a hedge or an underlying instrument could be a forward contract or a futures contract. In this instance, we are going to look at a forward contract. When it comes to hedging, there are three aspects that qualifies a relationship for hedge accounting. The first one is that they should be eligible hedge items and hedge instruments. What it means is they are separately measurable. The second is that the relationship is formally designated and documented, consistent with firm's risk management strategy. The third is that it must meet the hedge effectiveness requirements, that is the change in the hedge item against the change in the hedge instrument. What we mean by the third criteria about the hedge effectiveness is about the hedge item and the hedge instrument. Hedge item could be financial or non-financial. Hedge instrument is the derivative, has the same risk, but they offset each other. The second aspect of this is that the effect of the credit risk does not dominate this relationship. What it means is that one party, there are two parties in this contract, one party will not cause a financial loss for the other party failing to discharge the obligation. The third is that the proposed hedge ratio is similar to actual hedge ratio. So because the hedge item risk and the hedge instrument risk are similar, but they offset each other, and that offset, as a rule of thumb, should be between 80% and 120%. So there are three types of hedging. One is the fair value hedge, which we are going to look at. Then there's also cash flow hedge, and then hedging of the net investment or the net assets in a foreign operation, in a consolidated situation. When it comes to hedging, the way it works is that we got a hedge item and a hedge instrument. The hedge item is being measured at spot rate. So there could be a receivable amount. If it is a receivable amount, at the end of the period, we are going to get a cash. But during that time, due to, for example, if this receivable amount is in foreign currency, this foreign currency will fluctuate. And as a result, the receivable amount at the end would be different from what's at the beginning. So, but it's measured at the spot rate. At that given time, that's the rate. That's the spot rate. But it applies to a payable as well. Payable amount is the cash to be paid. Cash to be paid now versus cash to be paid at the settlement. But that will change if this is denominated in foreign currency. And whenever we want to measure, we measure the hedge item at the spot rate. When it comes to the hedge instrument, which is measured at forward rate, when we enter into a hedge agreement like forward rate, we agree to settle the contract at a settlement date which is in the future. So that future rate is what is applicable here. So the future rate is a forward rate at settlement. And whenever we measure the hedge instrument at a given time, we measure that in relation to the settlement date. For example, when we enter into the contract, at that time, at the forward contract, the value of the forward contract is zero because it's a future settlement date, a future contract to be settled. So right now, there's no value. So it's zero. But as time passes, the forward rate keeps changing, and the forward rate and the settlement rate is fixed because it's been pre-agreed. The difference between the forward rate at a given time versus the settlement rate will determine the change. That is, the change could be a loss or a gain, but it's in relation to the forward rate. An example, on 1st of July, Australian company has received an order to sell inventory to a foreign company and to receive 2 million forex on 1st of September as settlement. On 1st of July, the Australian company at the spot rate will receive 2 million Australian dollars. On that date, on 1st of July, since Australian dollar was strengthening against the forex currency, the company entered into a forward contract to sell 2 million forex on 1st of September and to receive 2.5 million Australian dollars from the bank through a forward contract. But the Australian dollar weakened against the foreign currency. On 1st of September, the spot currency rate led to a receipt of 1.5 million Australian dollars for the 2 million forex. If a forward rate is taken on 1st of September, the Australian company will receive 2.1 million Australian dollars for 2 million forex. So what we see here are the spot rates and the forward rates on 1st of July and 30th of September, but they are quite different. The spot rates, to start with, are quite different from the forward rates, and within the spot rates, they are different between 1st of July and 1st of September, and same goes with forward rates. 1st of July and 1st of September are different. So let's look at how you're going to record the journal entries. So there are two things here. One is the hedge item, the other is the hedge instrument. So first, let's look at the hedge item. So there's a sale that was made on 1st of July, and there's accounts receivable. That's been recorded as 2 million. 1st of September, due to the forex fluctuation, the accounts receivable amount that is receivable has decreased in Australian dollars to 1.5 million. So we record a loss, foreign exchange loss of 0.5 million, a debit, and accounts receivable, a credit of 0.5 million. And on that date, the cash is been received. When cash is received in relation to Australian dollars, it's worth 1.5 million. And because the currency that is maintained by the Australian company is in Australian dollars, we have to record in Australian dollars, and therefore we record debit cash of 1.5 million. Accounts receivable is now revised to 1.5 million, and we credit 1.5 million. When it comes to the hedge instrument, on 1st of July, the Australian company, entered into a forward contract, but it is for a future settlement date. Therefore, the forward contract has no value. So nothing is recorded on that date. But on 1st of September, the forward rate has changed in relation to the settlement date. So if the forward rate on that date is taken, which is 0.95 for 2 million of forex, what we're going to get is Australian dollars worth of 1.9 million. But at settlement, because we have pre-arranged the contract, we can sell the forex of 2 million at 1.25 and we get 2.5 million. That means there is a gain on the forward contract. 2.5 million less 1.9 million is 0.6. Gain on forward contract is 0.6, and forward contract becomes an asset, and that is 0.6 because it has appreciated in value. Now that on that date itself, forward contract is being settled, because it is appreciated in value from 0 to 0.6, forward contract is now settled between the company and the bank, and the company is having the asset, and the forward contract is now settled by the bank by providing 0.6 million worth of cash. So debit cash 0.6 million and credit forward contract. So what happened was there were two sets of transactions. The mainstream sales transaction, which is measured at spot rate, there was a receivable amount on 1st of July, which is 2 million, but it changed because of the exchange rate, and the cash received became 1.5 million. In that process, the company recorded a loss on exchange of 0.5 million, and it revised its receivables to 1.5 million. The hedge contract, which is the derivative, which is the forward rate here, started with a value of 0 when the contract was entered into. But at the settlement, the amount that has to be received was pre-agreed, amount that has to be settled was pre-agreed. But during that time, the forward rate also changed. And when the forward rate changed during that time, during that period, it made a gain on 0.6 million. When at the time of the settlement, when the company took its 2 million of forex and gave it to the bank because of the gain on the forward contract over the settlement value, the settlement value was stronger than the forward rate at that time. So therefore, the bank gave 0.6 million worth of cash to the company. So the cash that was received, therefore, is 1.5 million Australian dollars from the mainstream sales transaction, and then it also received 0.6 million from the forward contract. So together, the company received 2.1 million of cash. Otherwise, if there was no forward contract, what it would have received is just 1.5 million.